the Fed finally starts its long-awaited cutting cycle with a 50 basis point move, and crypto markets respond positively. Ethereum outperforms as altcoins catch a bid on liquidity measures unleashed in China. And the options market continued to price the US election as a bullish catalyst, as Kamala signals she will be supportive to innovation in the space. All that and more in this week's Crypto Options Unplugged. Welcome back to Crypto Options Unplugged, everyone. I'm Imran from Options Insight. I've got my man Dave from FRNT, and this week's special guest is none other than Stefan Rust, CEO and founder of Truflation. How you doing, man?
Doing good, thanks. Doing good. Just got off a flight from Singapore, so feeling tip-top.
Really, really excited to have you in the studio.
Yeah.
And remember, guys, like and subscribe to the podcast so we get big hitters like this coming on the show more often. So, Stefan, tell us about Truflation, man. You started, 3.5 years ago?
Yeah, started about 3.5 years ago, and really it was Jerome Powell saying inflation is transitory, and I just didn't believe that, right? I mean, just you print money, you shut the economies down, just doesn't work like that. And so looked under the carpet, saw how old the system is, how dilapidated, how manual, and felt that that could easily be innovated and brought about, we could bring about 30x improvement on the existing system. And so to me, that was like a red rag to a bull, and I'm going to go after that. And boom, we went after that. And today, Truflation has some 200,000 active users. We have 80 million items that we track from about 100 different sources of data. That's on the blockchain. So it's all transparent. It's maintained and managed by some 18 different node operators that are actually maintaining the data, but also ensuring accurate governance with the methodology and the compute of that index on a daily basis.
So what was your background before you started Truflation?
So I was a serial entrepreneur. So I launched a number of different businesses. My first business was textile advertising, but my second business was launching a mobile network in China.
Okay.
And so we launched mobile phones in China. And actually the physical network in 4 different cities throughout China, second-tier cities, Tianjin, Qingdao, Wuhan, and Shenyang. And yeah, that was amazing. It was like such a training ground for any entrepreneur, the Wild West. You were up against the regulator at the same time, who was the monopoly provider of all telecom services. We were the competitor trying to break in. It was price control, so we couldn't change any of the pricing. And we had to manage, in an environment. This was before prepaid phones, SIM cards, right? So anyway,
that's cool. Yeah, I mean, obviously I've started a business as well, and it's like amazing the challenges that you face as an entrepreneur that you don't know you're going to face, and you're just constantly kind of rolling with the punches and pivoting and trying something different until you finally get there. But okay, let's talk a bit more about Truflation. So yeah, I mean, it's clear that people just don't buy into the official data anymore, right? Like we've lost trust in institutions, in governments, and there's always people kind of think there's this agenda that people are trying to push, and they're going to massage the numbers to whatever that may be. A good example would be we're so close to the election, right? And so what do they want to do to the data? And the seasonal adjustments and all those things. So I can totally understand why there was a gap in the market for this, right? But so
it's like the perfect thing for blockchain, right? So
yeah, well, the blockchain. I was just gonna say, like, the beauty of what you're doing is we can hold you to account because your data is decentralized, right? Everyone can see how it's being calculated and how your indices are being built, right?
Yeah, so we make everything transparent. All the all the data sets are logged in there, and it's immutable, right? So we can't go back and change it. If you look at today's governments, 9 times out of 10, they go back, at least the US government, they go back up to 6 months back to change the data and the metrics that they have.
What's the point?
Exactly.
Right? All these revisions.
You can argue sort of they get fresh data, right? So the data that they're actually working with today is 6 months old, right? So if they're going back and changing 6 months old worth of data sets, that means that they're working today with data that's 6 months old, and at the velocity that economies move with mobile phones, with electricity, with computers that weren't around 100 years ago, they're not geared up to handle that, and let alone a rapid drop in inflation, a rapid drop and increase in unemployment data. How do they handle that, right? Do they have the right tooling to be able to work for that? And we just really feel that the government hasn't innovated as the tech industry has innovated, right? And so how do they keep pace with that? How can we help work with them around that?
And so by that, I assume then, so Truflation leads the sort of official numbers by 6 months, pretty much.
Yeah, I mean, I think it's in some categories, right? So in real estate, I'd say we lead by 6 months. On average, we say we're about 3 months ahead. On the data sets.
And what's the data telling you at the moment in the US particularly?
So right now it's 1.1%.
1.1%.
1.1%. I mean, it's okay. It went up to 1.3%. We're seeing an slowly picking up in terms of inflation. Commodities are getting a bit more expensive now. And so that has an impact on food. Food is a big expenditure of households in the US. People go to the grocery store 10 times a month. And so they constantly are seeing food prices move. And so that's definitely a big impact.
So who is like the target user of your data, would you say? Like who is it meant for?
So two things. One is really, we have two user groups, right? One is sort of the traditional finance, hedge funds, family offices that all want to use the data to calibrate it so that they can identify how that maps to government data and then help them predict where government data is coming out.
Okay, so like a lead indicator to government data for trading purposes.
And they don't they don't care about our index. They don't care about anything. Why? There's $5.5 trillion worth of debt that's linked to inflation. And so that's what they care about, and they trade off that. So, and then there's another segment, which is really the blockchain segment, right? Where they don't actually like all the necessary inflation index. They do believe it. They believe it is an economic indicator. But how can we tap the real world assets and prices and data sets that we've now aggregated and put on the blockchain to build interesting DeFi related projects and products and structured products that then can be traded as a perpetual, as a synthetic asset inside a lending pool, right? So then it becomes really interesting in terms of taking these new systems and building existing products on new rails and making it accessible to people that haven't been able to access products like that in the past.
And so when inflation was like high, the official numbers were really high. I imagine you saw them like double that level, right?
Yeah, so for 12 on the peak.
Yeah, so is it a case of your index is just much more volatile because you're seeing there's no smoothing going on, basically, I imagine, with you. You're seeing the real data and you're seeing those swings like are more violent, basically.
Yeah, I mean, we update it every single day, right? So we're going to have certain prices move on a daily basis, and depends on the weighting, it might have a bigger impact and a less impact. So then it'll move up and down a bit more, mainly just because it's updated every single day.
And like, something we've talked about a lot on the show is how this kind of Rubicon has been crossed in terms of money printing and government debts, right? And basically it means that you're kind of forced to debase currency over the long run, which is why we want to be long crypto and Bitcoin, right? So would you say in your data that you've seen that and there's like a consistently higher level of inflation than we are being shown, and that kind of backs up that view and kind of gives you that conviction that yes, you have to own Bitcoin for the long run for that reason?
Yeah, so look, memories are short term, right? We don't remember a lot in terms of timelines and history. Media like sound bites and clickbait, and the narrative is always chosen in favor of a positive story of the existing government, mainly because they influence the media a lot, but also inflation specifically is an important scorecard of how they're performing, at least in the perception of the population, etc. And so we may hear month-on-month inflation. We may see year-on-year inflation come down, right? Whereas now we're reporting the year-on-year inflation, but when inflation's really high, we just report the month-on-month inflation, right? So things like that. But if you look in aggregate, What we've experienced over the last 3.5 years is an inflation in the US of about 25%. So a quarter of your income has been, debased, or your purchasing power has dropped by a quarter. In the UK, it's even worse. It's up at 40%. And then you look back over the last 25 years, so quarter of a decade, salaries on average have only increased 20%. So my salary over the last 25 years is up 25%, but my cost of living in the last 3 years alone is up 40%.
Yeah, you're getting poorer.
You're getting, it's clearly witnessed, right?
And we can all feel it.
You can feel it, right? Yeah.
Yeah, yeah.
And that's like, as well, when you're looking at, say, baskets of sort of goods that we spend day-to-day money on, food and stuff like that, then you start putting into like the big items that your house, which is, how many times your salary and stuff like that now.
Yeah, so the asset price inflation as well.
Yeah. And that's where, I mean, I actually, so I push back against the idea necessary that Bitcoin's an inflation hedge. It's more of a currency debasement hedge.
People don't really understand the difference a lot of the time, though.
Yeah.
So how would you characterize the difference?
Like the difference is, well, we think about inflation in terms of like a more narrow basket. So now, when the Fed go, inflation's back at 2%. Well, that's fine. And actually post 2008, inflation as measured, like wasn't really an issue. In fact, we struggled to kind of hit that 2%. But then when you're not including house prices that are doubling, trebling, and that's everyone's biggest thing. And then all the issues that creates in society when you can't afford a home and these things. So the inflation over the years has been there, but it's been in asset prices.
Yeah, so I guess what you're saying is like CPI type baskets don't include like the asset mix that is representative of what you're going to spend the majority of your money on. Whereas to protect against that, you need to own an asset that does well when asset prices inflate. And the ultimate asset is Bitcoin in terms of what is keeping pace, in fact, outpacing those other assets, right?
And a good example, just today we're talking about China. So China have sort of brought out I'm not sure I'd call it a big bazooka, but
well, the equity market liked it.
The equity market liked it. I mean, it is big. I think they haven't come out with a fiscal yet, but
no.
But they've I mean, just to run through a couple of things that they've done. They're cutting the RRR, the reserve requirement ratio, which should unleash like 1 trillion yuan of liquidity into the economy. They're cutting existing mortgage rates by 50 bips. They're reducing the down payment required for second homes from 25% to 15%. And they're going to be cutting the 7-day sort of repo rate by 20 bips. It's a pretty full package. And then the other thing, which is quite interesting, they're going to allow brokerages to tap the PBOC for lending to buy equities. But basically what they're doing is they're artificially inflating the assets again. Equities, property. So in China, like property is like 60% of household wealth is in property, right? They've got a balance sheet recession going on. So no one's spending. And it kind of doesn't even really matter if you start cutting rates. No one's going to spend when the assets that they own are underwater. So now they need to reflate those assets. So that's what they're
finally realised that, have they?
Yeah. But they've been doing all this piecemeal stimulus and it never does anything.
Yeah, so essentially you're saying the wealth effect is more dominant in China.
Yeah.
Because they own that much stuff.
But here's the point, right? Fiat debt-driven economies require the assets, which are the collateral that underpin the system, to inflate. So then you can borrow more against those assets. So when you've got like a balance sheet recession like in China, they try all these things, but eventually you just reflate the assets. And that's where the currency debasement comes in, because you've got these artificially high asset prices all of a sudden. Yeah,
but only because you're printing money to buy them.
Exactly. So even if like the inflation baskets in terms of day-to-day goods and items and services that you might purchase might not change much. I mean, you start to get inflation because people start spending more because they're wealthier. But even if that doesn't really move, all of a sudden, house prices start to climb, equities start to rocket, and really nothing's happened other than you've just put a load more.
It's almost like you're saying currency debasement is a rich man's inflation, and the indices are a poor man's inflation, basically.
Yeah,
right?
Yeah, in many ways, yeah. And inflation, you could argue, is a form of debasement in a way, i.e. my currency buys me less.
Yeah.
You know, so it's all a form of debasement, but the big debasement that is where you got the asset price inflation.
And is the reason why ETH's ripping now because of this China stimulus, do you reckon? Because it was in the doldrums, like the really, really deep downtrend, breaking levels, and suddenly it's like outperformed by 10% in no time.
I think you know, correlation, not causation, and stuff like that. It all seemed to turn when Vitalik in Singapore got on stage and started singing.
Well, you were there, I guess.
Yeah.
The cheering section.
Did you see that?
Yeah, I saw. We had a chat about Truflation.
Yeah.
Talking about flat coins and at the Network Nations, Network Sets. Yeah, it was.
But I think in all seriousness, I think ETH. I think there's two things for ETH. Firstly, you know, altcoins generally are ultimately respond to liquidity. So I think the Fed cutting rates, you know, we start to get ahead of that liquidity. So there's that side of it, and then also the fact that, you know, ETH has yield and staking yield. Obviously, that starts to become more attractive in a rate cutting environment. When you I think there's kind of the yield like element to it. As well as the fact that we start to move out the risk curve.
Well, maybe also it was just a bit oversold, right?
And huge, like completely underloved. And
because I mean, I'm more long Bitcoin than I am ETH, and I'm not really going to change that before the election. I still think
Solana.
Yeah, I got a bit of Solana as well. Yeah, got to have a little bit of Solana.
The Ethereum killer, yeah.
Well, I thought Sui is the new Ethereum killer. I think.
Yeah.
Or the Solana killer.
That's the Solana killer, right?
I haven't quite migrated to.
That was the next killer.
And maybe I need to expand my portfolio. I don't know.
But I think what we need to do, at least in crypto, we need to find new blue oceans to go after, right? I don't think it's the point eating each other up and taking each other's land. It's more about creating new land, right? Because we can. We just got to be creative. We got to have the chutzpah to do so, right? In the past, we're also scared now. We've had Choke Point 1.0. We've put Pavel, into jail. We've put Rogers, CZ, Arthur Hayes. Everybody's been clamped down, and any sort of all people that have had sort of a slightly dissenting voice and opinion. Elon Musk, they're trying to put him in jail, right? So all of a sudden, they're trying to clamp down on too much innovation, too fast of a change. But it's the cat's out of the bag. And so I think it's really, how do we continue to innovate, continue to bring innovative, new, constructive products to market, right? We've done the meme coin thing. What's the next thing, right? And it's like, it's not going to be RWAs in terms of tokenizing a real estate. It's just going to take too long. You need a committee to approve a committee and a committee to then decide on which platform to build on. And then you're going to have a little tiny budget. And by the way, that budget's going to be competing against cybersecurity, right? Which the WEF has endorsed, and everybody's career is going to be protected if you do cybersecurity and allocate some of your IT budget to something like that. Or now we got to do AI, the agentification of everything, right? And so how do we get into those worlds? So that's what, from an enterprise and institution perspective, that's what crypto's competing against. And so we need to find new opportunities and get the retail to get asset appreciation in other asset classes, right, that are not available today and not available to the 1.7 billion people that cannot trade in Wall Street and cannot, you can't, I mean, there was a video, did you see the video going out today where some old trader on the NASDAQ New York Stock Exchange was explaining how you have to buy a booth and then you have to lease a desk from the people that have been given permission to buy the booth to be allowed to then go and trade, right? And so, and today we have all these Uniswaps and we can trade all and do whatever we want to do on any platform, from indexes to perps to, options to anything, right? And so...
So, last week, obviously we got the 50 basis point cut, right, from the Fed.
Yeah.
So you are the Truflation man, right? Okay. So tell us, is the Fed getting too aggressive and thinking that the battle with inflation has been won? What would you say to Jerome Powell if he was sitting here?
So 3 months ago, we actually forecasted that they wouldn't drop rates until this month. And the reason why is I think it's an election year. And the incumbent administration is wanting to see a re-election of the existing party. And so big drop now, stimulate the economy before the election, and then we might see a repeat of the existing administration stay in power. And then we'll see another drop, I think, just before in November when they come together again. And then another one, I think they have another meeting in December, right? Yeah. So we'll see another 50% basis point drop before the end of the year. But I mean, I think it's less inflation, right? They should have started earlier if they wanted to tackle inflation. It's the employment. We have a big problem in the employment side, right? The employment numbers just don't add up. And we're seeing actually immigration is creating a lot of confusion in the employment data. So you're seeing employment numbers go up, and at the same time, unemployment numbers go up at the same time.
Have you not got a true employment number?
Check out our labor data.
Surely that's the new product that we all need to see.
True employment.
We got true employment. Yeah, we got true production.
I think I'm going to have to copyright that before you launch it. But
there's a really serious point though, because like we talk a lot about cycles, and once you've kind of been following and trading this stuff, you do just see like these cycles, and like, you know, you can argue Bitcoin follows this 4-year macro cycle, but part of the issue that I have is like the Fed always over tighten and then they keep rates too low too long. But part of the reason for that is because they're looking at this lag data, and then they're also not only are they looking at lag data, they also struggle to kind of really understand the lagged transmission with which their policy acts. So if you think there's like a 12-month-ish lag in the transmission of that policy, i.e. before the cuts actually start to impact, if you're cutting now to data that's about 6 months stale in a way. Like when you're saying, well, inflation's where 1.1%
right now, actually.
So they're undershooting already. So they should have cut. And now you probably got, call it 12 months for the cuts to really start to impact. So actually the risk now feels to me you potentially go into a deflationary cycle, which, by the way, when you're carrying a shit ton of debt is worse than inflation, when you probably want to inflate it away. So you're constantly going to be making these errors, which central banks do, because you're looking at lag data. So then when you do act, you're forgetting with the lags within which that policy action takes. So if they start to see, if they follow your data, and in the next, say, 3 months, and the lags with which their data will kind of catch, in this case, down to yours, what they won't do is go, well, hang on, this is past data, and cutting today is going to take effect in a few months' time, or down. They'll just go, oh shit, we just cut and it's not done anything. We'll do another 50. We'll do another 50. Do another 50, and then we'll start to see your data turn up, and you'll be going, well, hang on, you've probably done enough here, guys. And they're going, well, no, it's still lower, and then they'll overdo it again on the that side.
Because you can also see in history shows that whenever they cut big, there's a lag. The markets react really positively, right? Look what's happened in China. And then over time, it'll sort of sink in. Why are they doing that? What's going on? Why so big all of a sudden? And then they realize, whoa, there's maybe a really big hole somewhere that we haven't really taken into account. And then all of a sudden, the market recorrects itself. And then the governments have to then, or the Fed has to then all of a sudden do something big again to shock the market, so then they're then surprised, and then it has the impact that it's hoping to achieve. And I think these cuts were big. I mean, 50 basis points. I think we all expected or anticipated it, but we didn't actually really think they were going to go that far. I didn't think Jerome Powell was actually going to do it.
I don't know. I was saying in last week's episode that they kind of had to, once the market priced 60% probability and they were backed against the wall, the last thing they want is to cut 25 and tighten financial conditions, right? So they kind of had to go 50 to achieve a dovish outcome.
Well, they've got there's no October meeting. Next one's in November. I mean, I think it kind of felt like this is 50 for, we probably should have gone in July. We can't go in October.
That's what everyone seems to be saying.
And then they've been at pains to kind of suggest that don't expect 50s going forward. It's going to be 25s. But I mean, this is where I think and we had the discussion last week, why I think it's like risk positive, because at least right here, right now, we're not cutting into a really stressed situation you know, the US economy is slowing, it's not collapsing. Financial markets, obviously, sort of, you know, we're near record highs or at record highs in many equity markets. So they're cutting into this slowing economy, but not collapsing, with a disinflationary backdrop. So it's a really like nice kind of mix for risk. JP Morgan put out last week that 12 times the Fed have cut with the S&P 1% from its record highs, and all 12 times the S&P has been higher a year later on an average gain of 15%. So it just kind of puts a little bit of cold water on the idea that Fed cuts are negative for equities, and particularly when they cut 50.
Sure. I mean, if they were cutting because they're like panic stations, that'd be one thing. But yeah, I agree. It's probably not the case right now. That's not to say we don't get a seasonal dip.
The number of bankruptcy filings amongst small, medium businesses, that's up, significantly up over a consistent set of months. You look at the number of startups that have shut down. A lot of startups have shut down. You look at the big businesses, what are they doing? Their revenue per employee has grown significantly. They're now generating $2 million on average per employee at a company. You look at their push into AI, agentifying everything. You're going to lay off all your call center support staff. So there's going to be a lot of change coming into this economy, and a lot faster than I think a lot of us are anticipating.
Yeah, but what you're arguing there is you're saying the state of the real economy isn't necessarily that great if you look under the hood at small businesses and things like that.
Watch that GDP number drop from a 3% down to 2.5 or 2 or something like that. It's going to be a big revision downwards, right?
Yeah.
And remember, they revise every 3 months. Again, it's like, oh my God, that was like 6 months ago, right? And so then we know the actual GDP numbers.
Yeah, and I agree with you on that front. I just think that the stock market is not the economy, right? And I think that the S&P, we've seen it time and time again, right? The economy can tank. It gives the Fed an excuse to go super easy on rates. And guess what happens? We inflate asset prices in the biggest mega cap tech names all over again, and the Nasdaq and the S&P rally. So the Russell won't rally. The Russell 2000 will underperform and continue to underperform in that world. But that doesn't mean the S&P doesn't go 6,000, unfortunately, right?
So the trickle down effect of the money doesn't actually take place. It gets to the banks, and then boom, it goes into assets, goes into the S&P 500 and other investment, real estate or other assets, right? And so it doesn't actually get passed down to small, medium businesses, to the individual, unless we get another stimmy check, right? Or something like that comes back.
Yeah, and that was a big thing that changed during COVID, right?
Yeah.
Like, that was the first time, you know, in a long time where we've had a stimulus that actually put money directly in people's pockets.
Yeah, that's right.
You go spend it.
And that's when we got the craziest inflation we've seen in how many years?
Like we say, like it's kind of, I almost think the way central banks act and even governments, it's kind of like socialism for the rich. It's like, well, we're gonna pump stock markets. Most people don't own the assets. Doesn't impact them.
Yeah, exactly.
We're gonna pump housing. Like great if you own the asset of housing. But so you have this kind of dichotomy, and the financial economy is pumping, but the real economy is not, and that's why you get this like inequality and all the unrest that it causes in society. And Bitcoin fixes this.
So speaking of Bitcoin, right? We had a little pop.
Yeah.
Right. I'm not convinced by it.
I know you're not. Yeah, I know.
We're at 63K.
Yeah.
We're yet to break that 65 area, and then the 72 area is really the big one.
Yeah.
Right.
Yeah.
I mean, everyone's saying that September's seasonally poor, but then October tends to be the best month ever for Bitcoin. Yeah. Right. I'm personally still thinking we get risk asset weakness into the election. That's my bias right now. But when do we get this? When do we get this breakout on Bitcoin? Are we going to see new all-time highs by the election?
It's called Uptober, right?
Uptober.
It is called.
Yeah.
They've named it exactly. What do we think?
Yeah, stop trying to be sensible with this stuff. We've spoken about. I mean, the conditions for Bitcoin to rally have been there, as we've discussed, for several weeks now. Fed are cutting rates. We've now, they've cut more than what we were expecting just a few weeks ago. And also, I thought the other interesting thing was it's not like they've just cut, and like they've really teed up a cutting cycle, another 50 bips by year end. you know, global liquidity is picking up. ECB now look like they might actually cut again next month. And now China have got the cover from the Fed to go full bazooka, which they're now kind of pulling.
I mean, if anything, out of all the things you've just said, it's the China move that makes me more bullish.
Yeah.
Right. The fact that they're getting aggressive now.
So right? Everything's there. I think the fundamentally the backdrop just is primed for Bitcoin to rip. There's clearly been, as we've discussed, some kind of sell flow out there. Every time we got on that 60K handle dump. Now the question is now, is that seller still out there? Is there a flow out there? And they've now just gone, well, maybe 65 is the level we give now, given this pump. So that's still to be seen. But I just think that this change in this macro dynamic will now draw some real demand in, which can kind of start to pump us. And I think the other thing with Bitcoin into the election, obviously Trump is going to be seen as the more positive.
Kamala's talking it up,
but she's now talking it up. So I think that's another thing that, and then into October, I just think we could well see like a decent pump into the election. I
mean, the vol market is certainly pricing a bullish catalyst, right? And what I mean by that is, like, if you look at where the skew is in crypto vol, we had a put skew, right, in the short end, first couple of months. That flipped into a call skew after the election and including the election expiry. And now this little pop we've had in spot, you've got about a neutral, very, very, very marginal put skew still in the front. But again, that inflection point where it flips from a put skew to a call skew is the election, right? And then you get call skew all the way out the curve. So it's kind of the options market saying that, yeah, once that election is out the way, I mean, there's a reason to own calls over puts, basically, still, right? Yeah. So they still are pricing it. Not quite as excited a bullish catalyst as it was, like paying 5 to 8 vols over for calls. Now maybe they're paying a couple, 2 or 3, but it is still being priced like that. And there was that big call spread buyer on Ethereum who must be laughing right now because Ethereum's had a good rally to December. But yeah, generally that seems to be, but the way I see it right now is like, I'm happy to be cautious here. But if levels start breaking to the upside, I'm not going to be stubborn, right? Yeah. And the vol's cheap enough that you can just add some calls as it's breaking, and then run that long when it happens. Basically,
I think as well. I still feel the market's like underpositioned in Bitcoin. I think the market's underpositioned in equities. We came in September, like we spoke about the seasonality, so everyone was expecting a really weak September. Well, now equities are back at pushing record highs. I actually think there might be some false chasing, so I still think pain is higher in terms of
crypto or in stocks.
Both, because okay. I think a lot of crypto managers that seek to outperform Bitcoin are probably underperforming Bitcoin, and then they're forced to reweight to at least try and keep track with it. And the same in equities, that everyone's underperforming equities, so they need to just reweight higher. Yeah. And they can't just keep watching it run and go, well, let's just hope it shits the bed into the election.
Do you know what would be super interesting? They've approved the options on the ETF, right?
Yeah.
And we know that the options market is a bit nutty in the US, right? So now if all the retail options crowd can suddenly start piling in,
guys.
Yeah, exactly. If those guys can pile into options on IBIT,
yeah.
I mean, that in itself could bring a load of buying as well. So yeah,
it's also as well, like, I mean, you could all about all that craziness, like all the GameStop type stuff come into this and pump things. On a very kind of serious note, I also think, like we know, like derivatives facilitates like institutional adoption in terms of the ability to hedge and yield generation and all this stuff. So I think it's going to really help the institutions that want to come into this market. Okay, you've got the ETF, but we haven't got some of the derivative products that we need to kind of trade around that and protect around that. Well, bang, there you go, and there you have. So I think that's going to again just encourage that, and it's just another sort of step in the kind of institutional adoption story that ultimately long term is going to be very positive for our market.
Mm-hmm. All right, Stefan. Yes. Any takeaways you want to leave us with?
No, I mean, you're seeing a lot more institutions come in, right? I mean, it's obvious, in Singapore, the market's gone from 10,000 attendees to a crypto conference to now 20,000, right? So, and all of those were institutions coming in, right? And all the service providers to support institutions. And so that's going to be an interesting momentum.
Yeah.
I think we've seen a lot of liquidity come into the market. You've seen, in the US with the 50 basis points, you've unlocked maybe nearly $800 billion worth of capital. Where's that going to go? A portion of that's going to go into risk assets, and those risk assets are going to be options, but they're also going to be crypto assets, right?
Mm-hmm.
And then in China, they just unlocked another 200 billion, just alone. The reserve ratio that banks need to hold, that alone is $200 billion. Where's that going to go?
Mm-hmm.
And the Chinese and the Asians are very bullish on crypto as an asset class.
Right.
And the youth, the retail investors, they see that as the new hope, right? They're really, it's not real estate anymore. Where am I going to put my money in? I can buy in funds, but I can also put it into crypto, right? And maybe crypto funds will start emerging. And I think we'll see beyond just a boring ETF, we'll see a blend of different types of funds, the traditional type indexes that they can then all of a sudden invest in. I think that's going to be a really interesting spot. And then those can then be lent against, and they're going to be borrowing against that, which is totally underserved in crypto. There's no borrowing in crypto. It's all 100% over collateralized.
All right, mate. It's been a great discussion. Really appreciate you coming on the show for us. And
thank you,
guys.
Great having you. Great having me. Thank you for having me. And
no, it's a pleasure. All right, guys. Hope you enjoyed the episode. We'll catch you all next week. Cheers.